Is it possible to claim universal credit if you have savings? Stay tuned as we explore how savings can affect your eligibility. Before we dive deeper, don't forget to hit the like button, subscribe to our channel, and drop a comment below sharing your thoughts or questions. Engaging with us helps our channel grow and allows us to bring more content like this to you. In today's video, we are going to break down the impact of having savings on your ability to claim universal credit. We'll look at thresholds, how savings are assessed, and what this means for you. Understanding these rules can significantly affect your financial planning and support. We will explore the specific amounts of savings that might change your eligibility for universal credit. Knowing these details can help you manage your finances better while ensuring you receive any benefits you're entitled to. Lastly, we will provide you with practical advice on how to report your savings when applying for universal credit. Correct reporting is crucial and can avoid potential complications with your claim. Now, let's get into the details of how savings can affect your universal credit. Universal credit is a payment to help with your living costs. It's paid monthly or twice a month for some people in Scotland. You may be able to get it if you're on a low income, out of work, or you cannot work. Savings can affect your eligibility for universal credit. If you have savings over PS 6,000, this starts to affect how much universal credit you can get. For every PS 250 you have over this threshold, your universal credit payment reduces by PS 4.35. If your total savings exceed PS 16,000, you're generally not eligible for universal credit. This includes everything from cash, shares, bonds, and property that you do not live in. It's important to understand that the value of your main residence and personal pension are not counted as savings. Your savings and capital are assessed together when you make a claim. If you're part of a couple, your partner's savings are also considered, even if they are not making a claim themselves. This combined assessment could influence the total benefit you receive. It's essential to report your savings accurately when applying for universal credit. Failing to do so can be considered as benefit fraud, which carries serious penalties. Make sure you update your information regularly, especially after any significant change in your financial situation. If you're close to the savings limit, consider how your circumstances might change. Unexpected expenses or changes in income can affect your balance and eligibility. Keep detailed records of your finances to ensure you can provide accurate information when required. For those who have recently received a large sum, for example, through redundancy or an inheritance, it's important to know how this will affect your claim. You may find that your universal credit payments are temporarily stopped or reduced as you reassess your financial situation. Managing large sums of money while on universal credit can be challenging. If you find yourself in this situation, seeking financial advice might be beneficial. They can help you plan and make the most of your funds without jeopardizing your benefits. It's also worth noting that certain types of payments are not treated as savings. For instance, loans, redundancy payments held in a bank account, and certain types of trusts. Knowing which assets are accessible and which are exempt can save you a lot of confusion. Remember, the rules regarding savings and universal credit are there to ensure that those who need support the most receive it. If you're unsure how your savings might impact your claim, consider contacting a financial advisor or the Citizens Advice Bureau. They can offer guidance tailored to your specific situation. In summary, while having savings can complicate your claim to universal credit, it does not automatically disqualify you. Understanding how your savings affect your eligibility and payments can help you navigate this aspect of financial aid more effectively. Exploring the advantages and disadvantages of having savings when claiming universal credit can provide a clearer picture of how to best manage your finances while receiving benefits. One advantage is that having savings gives you a financial cushion. This can reduce stress and provide security in case of unexpected expenses or delays in receiving universal credit payments. However, this needs careful management to ensure it does not affect your eligibility. A disadvantage is that savings over PS 6000 can reduce the amount of universal credit you receive. For every PS 250 over PS 6000, your universal credit reduces by PS 4.35, which can significantly impact your total benefit amount if you have substantial savings. Another advantage is that having savings can help you avoid debt. If an unexpected expense arises, you can use your savings instead of taking on high-interest loans or credit, which can be harder to manage on a low income. Conversely, a disadvantage is that if your savings exceed PS 16,000, you are ineligible for universal credit. This can create a situation where you need to use your savings until they fall below the threshold, which might not be sustainable in the long term. An advantage to having savings while on universal credit is the potential for investment. If managed wisely, investments can grow your savings and help offset any reductions in universal credit due to having over PS 6000 in savings. However, there is a risk involved in investing savings. Poor investment choices can lead to losses, which is particularly concerning if you rely on those savings as a financial safety net while receiving universal credit. Another advantage is that certain types of savings, like pensions or life insurance policies, do not count towards the universal credit savings limit. This allows you to plan for the future without jeopardizing your current benefit eligibility. Finally, a disadvantage is the need for meticulous record keeping and reporting of your savings. Failing to accurately report your savings can lead to issues with your universal credit claim, including overpayments that you might need to repay or even sanctions. Before we move on to the rest of the video, if you are finding this helpful, please like, subscribe, and comment, as it really helps this video reach a wider audience. Here is a case study related to universal credit if you have savings. Emma, living in Bristol, found herself unemployed unexpectedly and needed to apply for universal credit. She had PS 8,000 in savings, which she knew would affect her claim. To manage her finances effectively without losing her entitlement, she decided to use part of her savings to pay off her existing debts, which not only reduced her monthly expenses but also brought her savings below the PS 6000 threshold, minimizing the reduction in her universal credit. Emma also sought advice from a financial advisor who helped her understand how to declare her remaining savings and investments properly, ensuring she remained compliant with the regulations. By taking these steps, she was able to maximize her universal credit payments while maintaining a safety net of savings for future needs. If you find yourself in a similar situation, it's important to assess your savings and how they might impact your universal credit. Consider using excess funds over the PS 6000 limit to cover essential costs or pay down debts. This can be a strategic move to both manage your finances better and maximize your benefit entitlement. Additionally, always keep records of your savings and financial transactions. Regular updates to your universal credit account with any changes in your financial situation are crucial. This not only helps in keeping your claims legitimate, but also ensures you are receiving the correct amount of benefits. If this video was useful, please do like and subscribe. It helps us bring more useful content to you and is greatly appreciated. Thank you for watching, and remember to stay informed and proactive about managing your finances while on universal credit.